Question we want to ask now is how does monetary policy both affect aggregate demand and then the rate of inflation? So we've talked about a few things already. One is the market interest rates, right? So we said the central bank can change the policy interest rate, the federal funds rate in the United States, but has different names in different countries. And then that affects market interest rates because it represents the cost of finance for the banks. And so when the federal funds rate goes up, other interest rates go up too, and vice versa. It can also affect asset prices because when interest rates are low, investors tend to want to invest in other assets, whether it's stocks or houses or whatever. And so that can affect aggregate demand. And it can also affect expectations and confidence. And so if the central bank says things are going great, then that can make people think the economy is doing well. When they say, oh, well, the economy is not doing as well, people might lose confidence, and that can affect how much people buy. And then finally, it can change aggregate demand through the exchange rate. Now, the exchange rate is not something we've talked about much. We're going to come back to it in chapter 16. So we just want to go through how the interest rate affects the exchange rate and therefore then affects aggregate demand. So the exchange rate is the price of currency, right? It's how much home currency you can get for a foreign currency. So it could be dollars per euro, dollars per yen, dollars per pound, dollars per peso. And of course, the exchange rate can be either way. So you can get dollars per pesos or pesos per dollar. And so it can be a little confusing sometimes. How the interest rate is going to affect the exchange rate has to do with the fact that investors can invest around the world. And so when one country's interest rate changes, whether it goes up or down, that's going to make some investors want to move their investments from one country to another. So, for instance, if the United States lowers its interest rate, then investors won't want to buy as many US bonds. They'll want to buy other bonds. And so they will sell their dollars and buy euros or yen or pesos or pounds. And so that's going to change how the dollar is valued. Now, that's important for the goods market because with a more expensive dollar or a cheaper dollar, that's going to change the price of both imports and exports. So, for example, if the dollar gets stronger, that means imports are cheaper, but exports are more expensive. So, US consumers will buy more imports, but consumers in other countries will buy fewer US exports, and that will weaken aggregate demand. We're going to come back to that a little bit more in chapter 16, but it's important to think about. So let's just walk through this. We'll do an example with the Australian dollar. So let's say there is a fall in investment in Australia. So investment goes down, right? Investment is a piece of aggregate demand, so that leads to a decrease in aggregate demand. And because aggregate demand falls, that means there's a fall in forecasted inflation. And so the Australian central bank says, all right, well, we've got a fall in inflation. That means we need to cut interest rates. Well, if we cut interest rates, people aren't going to want to buy Australian bonds as much because the interest rates are lower. They'd prefer to buy Japanese bonds or US bonds or European bonds. And so there's a fall in demand for Australian dollars. Well, if there's a fall in demand for Australian dollars, that means that the value of Australian dollars has to fall, and that's what we call a depreciation. And so if the Australian dollar depreciates, that means that exports become relatively cheaper and imports become more expensive. So consumers in Australia will buy fewer imports, and people in other countries will buy more Australian exports. That means X goes up, M goes down, and we get an increase in aggregate demand. And so that actually works in the same direction as for instance, the increase that we would expect in domestic investment because of lower interest rates. And so all of those, a decrease in interest rates tends to push aggregate demand up, whereas an increase in interest rates tends to push aggregate demand low. So let's walk through that and see how that works, right? So keep in mind when we have this model of aggregate demand where aggregate demand eventually equals output, we can think of the central bank as trying to shift aggregate demand to our full employment outcome, right? The labor market equilibrium. So if we think we start at position A here, I'm going to move myself just up a little bit, and we get a fall in consumer spending. So C0 shifts down to what we call C0 prime, and we go from A to B as our new equilibrium. So now the central bank says, all right, well, B, that is a higher unemployment rate, that's lower real GDP. We want to get back to A. And so what the central bank is going to do then is to cut the interest rate and try to increase investment, right? So remember that investment increases because now investment is cheaper. The interest rate really represents sort of the cost of investment. And so now investment will go back up and hopefully will shift aggregate demand back up so that we are closer to point A. And as we said, of course, with a lower interest rate, that means that exports should increase and imports should decrease through the exchange rate. And so that will also help us move back to A. So we can look at sort of what happened in the dot-com recession in 2000 to 2003 and how both fiscal policy and monetary policy responded to the collapse of the bubble and technology stocks. So 2000 was sort of the last boom year of the 1990s. Real GDP increased at 4.1%. Non-residential investment was up. Residential investment was slightly lower. Government expenditure contributed to GDP. And the federal funds rate was 6.24% on average, right? The unemployment rate was only 4%. And inflation was 3.4%, which is low by historical standards, but had actually started to creep up a little bit compared to the pretty low inflation we had in the 1990s. The stock market collapsed at the end of 2000. By 2001, GDP was only growing at 0.9%. The federal funds rate was cut to an average of 3.9%. The unemployment rate was 4.7%, and inflation had fallen to 2.8%. And government had increased spending, and so they had increased spending to boost GDP by 0.88%. 2002 and 2003, the economy started to recover, but somewhat slowly, and government spending still contributed positively to GDP. The unemployment rate sort of hit a peak in 2003 at around 6% before it started coming down. The inflation rate actually fell in 2002 again to 1.6% and then recovered a bit in 2003 to about 2.3%. The federal funds rate was kept pretty low at 1.67% on average in 2002 and 1.13% in 2003. And it really wasn't until sort of 2004 that they started to increase the federal funds rate. It was back up to about 5.25% before the recession hit in 2007 when they dropped it all the way down. And so that brings us to one of the weaknesses of monetary policy, which is the zero lower bound, where the policy interest rate, the federal funds rate in the United States, can't go below 0%, right? Because otherwise people would just hold cash, which pays 0% interest anyway, and it's easier to deal with. And so once it got to the zero lower bound and the economy still hadn't recovered, the central bank needed to try something else. And so what they tried was something called quantitative easing. And with quantitative easing, the central bank buys other financial assets than they usually buy. In a usual case, in order to reduce the federal funds rate, the Federal Reserve buys treasury bills from banks and increases the reserves in the system and lowers the federal funds rate. Well, in this case, what they decided to do was to both buy mortgage-backed securities, which the banks had a lot of and nobody else wanted to buy, and to buy treasury bonds, which are just longer-term government bonds. And the goal was really to try to reduce long-run interest rates. It was, I would say, only modestly successful, and they're just starting now to sort of unwind the quantitative easing that took place. In this last bullet just points out the fact that countries that belong to a common currency, like the Eurozone, don't have their own national monetary policy. And this was a huge problem in Europe because we had unemployment rates in places like Greece and Spain that were over 20%, whereas the unemployment rate in countries like Germany and France to some extent were pretty manageable, not didn't really get that high. And so the question was, well, where should the European Central Bank aim its efforts? Should they look at the countries that were really struggling, or should they look at the bigger countries that were doing better?